Thank you very much, Jared. Thank you for the introduction. Good morning, everybody. So I've got three distinguished panel members today next to me. So you've got Kevin McDowell from Alberta Teachers from my left, Guthrie Stewart from PSP, and Geoffrey Geiger from USS. We'll try to keep the interaction with the room as live as possible, so there will be a Q&A towards the end of the session. Maybe to kick off, maybe really in 20 seconds, a quick introduction of yourself, your role, your organization, before we go deeper into effectively how you address the market.
20 seconds. Well, first of all, it's 3:30 in the morning where I am, so apologize if I drift. And some of my colleagues threatened to listen into the live stream, and they better not be. They should be asleep. 20 seconds. Alberta Investment Management, we're based in Edmonton, Alberta, Canada. I head the private equity funds team. We manage 15 billion Canadian assets, so Guthrie will talk about a little bit the difference between the two Canadians in terms of size. About 10 billion euros, with a concentrated GP platform of about 15 GPs. Maybe a little over 20.
Thank you.
Okay, so also Canadian, although I guess I got a two-hour time advantage over you. So PSP, we're the new kid on the block, if you will, amongst the large Canadian pension plans. We were started from zero assets 15 years ago, and we're now over 125 billion. I came on a year and a half, essentially to ramp further our private investment program. I look after private equity and infrastructure, so we have a very active both fund and direct investing program. I myself curiously come from an operational background, so when I joined the firm, people assumed that meant we would push our direct investing program much more dramatically, but I could talk later about my sort of strong beliefs of partnership and doing what we do best and working with strong partners.
Thank you.
Yeah, I'm Geoffrey Geiger, USS. We're the university pension fund for the universities in the UK. We have about 55 billion pounds of AUM in total. About 12 billion of that is in private assets, including private equity, which makes up about 4 billion pounds of the program. We also run a very concentrated set of GPs, about 15 or so in private equity, and then 3 or 4 more in special situations. And increasingly looking to invest directly alongside the private equity program alongside those GPs.
Thank you. Thank you very much. So maybe we could dive straight into obviously the theme of the panel, which is LP-GP relationship, but in particular because when we caught up over the phone in preparation of this panel, the overall theme was the industry is evolving. It's evolving towards potentially a more asset management type of dynamic, and so to some extent, you three illustrate already that evolution to different levels. So. Some of you are not, none of you are anymore a traditional LP. So you're moving from an evolved LP towards maybe a modern LP, being very active on the investment side. So could you maybe elaborate now a bit more really in terms of how you focus your investments from funds to direct, co-lead, and else?
Sure, I'll start. So about 7 years ago, we were actually I shouldn't say just, but we were a funds of funds program. Basically run on the side, a small allocation. Our allocation went from 5 to 10%. We also added a 10% infrastructure allocation, and when they created our private investments team, at that point, decision was made to go into funds and co-investments. Unlike some of our Canadian colleagues, we haven't gone down the true direct path. We can co-sponsor deals, we can take deal pursuit costs, but we've so far worked with our partners. And so, with only 15 GP relationships, we spend a lot of time with those GPs. We spend a lot of time on the road. We're a little isolated in Edmonton, Alberta, Canada. So you come to Berlin, you come to these events in Amsterdam. A couple of weeks from now, I'll be in Mumbai and Singapore. We really cultivate a relationship and try to make sure the GP remembers we exist, explain what we're looking to do, prove that we can move fast. We've built out a co-investment team, which is I think a little bit unique for someone our size. You know, it allows us within about 48 hours at least say yes or no, we're interested. So we spend a lot of time on the relationships. It's very important. Again, the isolation is part of that.
Thank you. Maybe if we go first to Jeffrey, if you don't mind.
Yes, I mean, our history, we did start out in alternatives, allocating to private equity funds and with a private equity fund program. I think our evolution towards direct started in the infrastructure space, where we found that investing through funds in infrastructure, we weren't really getting the right kind of risk that we were. The reason we were investing in infrastructure was to get inflation linkage, inflation-linked returns, hopefully of a lower risk. And we weren't necessarily getting that in a fund with a private equity structure where incentives were around money multiple. So that naturally led us to start looking at transactions directly. We started doing some transactions. We grew the team around that. And on the back of the success there, in parallel with the odd co-invest that we were doing on the private equity side, we grew increasingly confident about our ability to transact directly. And as that's evolved, we've become more and more a direct investor. And we regrouped all of the illiquid assets at USS, including real estate and infrastructure and private debt, into one group, so that we can look at illiquid, you know, peer-to-peer transactions in one group and allocate our time where the best risk adjusted returns are. And so now we're about 55% direct across all the private markets, and 45 through funds. On the private equity side, just because of the greater involvement and value add that's required for private equity, we're still leading with our allocation to funds, and we certainly look to our GPs, our core GPs, to lead that effort. And then we try to pick our spots to work alongside them on assets that we think there's a really good fit for us as a pension fund. And so on the private equity side, we're about 70% in funds today and 30% in co-investments and directs.
And just building up on Kevin's point about a reasonably limited number of GPs, is it the same experience on your side, which is that to focus a lot on directs, you need to have only a few GP relationships, or not necessarily?
Yeah, I mean, there's really a practical reality that there's only so many relationships you can work on with a limited number of people, and it is ultimately doing deals is a face-to-face exercise, and you want to know the GPs well. You hope they will know you and trust you as a counterparty they can work alongside. So you naturally need to gravitate to the people where there's an affinity and there's things that you can work on together, and not have a long list of fund monitoring responsibilities that detract you from that kind of time-consuming deal-doing activity.
If I can just add, in addition to concentrated program for monitoring reasons and for relationship reasons, there's math on our end. We're a smaller plan, and to get in front of or top 10, top 5 for a GP, write a reasonable ticket. There's a little math driven as well.
Yeah, I would agree with that theme. Also, in our case, we've actually been adding to our relationships. I mentioned we've been a fairly fast-growing fund, so we have both the opportunity and the challenge of scale is a big issue for us. So we really think about our fund relationships in almost a portfolio construction manner. Looking at geographies, different strategies. We try to map this out, show our board on an ongoing basis how we're thinking about our fund relationships. And that really is the cornerstone of our program. And then on the direct side, we think about directs in both a co-invest way, but also increasingly in a co-underwriting way. So we're trying to work alongside our partners. Again, it's a scale question. We also believe it gives us greater scale opportunities, but we also believe it gives us deeper relations and better insights with our partners. If we can actually work alongside them, then you get a much better sense of what the partner's strengths are and how you like to work together. So there's a natural tendency towards concentration, but at the same time, I think you need to keep thinking about the new funds that are coming along, the new alternatives. Yeah.
And Guthrie, could you elaborate also a little bit in terms of the history within your organization, when and how it moved from fund investments to a much more hands-on approach of the market?
Yeah, and our experience is somewhat interesting in that we actually probably ran before we walked. So we went very rapidly from fund investing to direct, and I would say in our fund investing almost exclusively, or certainly focusing on what I'd call bespoke funds. So when I arrived, I inherited a number of funds that frankly I didn't even know who they were. So quite interesting characters that we had picked up along the way. Very interesting strategies, very interesting investors. But a challenge of scale and frankly also a challenge of risk. That we had probably taken on more risk across the portfolio because we were invested with a number of very small funds and a challenge of scale in terms of direct investing. So we've actually shifted the strategy back, if you will. Not that we still enjoy our bespoke relations. So I don't want to leave that suggestion, but it really was running before we walk. So we've graduated or migrated back to having more core relations, and again, that gives us more scale on the direct and co-investing opportunities.
Thank you. Thanks for that. I mean, maybe one topic I wanted to explore a bit is very practical, because of course we will discuss what everybody would expect in the room, which is the economics. That's a theme that we cannot avoid. But before going there, maybe from a practical perspective, and maybe even more for you two on the far left, all of us, we know LPs where you've got a team of 2 or 3 people managing 5 billion of assets, and by definition, when you have that setup, it's very difficult to do anything else but fund investments, because you are constrained by the team and the resources. Sometimes, so the first step is to go towards a bit of co-investments. So how do you think at USS and at PSP, how do you think about the team, how to build the team, how many people, maybe AUM per capita, maybe different metrics? Because it's obviously a necessity to get it right to be able to engage in your strategies.
Yeah. I mean, one thing we have is we have to report on how much fees we pay to managers. So our total budget at USS Investment Management includes our internal costs as well as our external costs of external managers. And so you can imagine, if you think about the fees that we pay on committed capital to private equity funds, that becomes very quickly a multiple of our internal costs. And so framing it in that context is really a big driver, if you like, of in terms of our governance as to where we should be allocating our resources. The dialogue about increasing the resource internally is quite simple, because we can effectively, as we become more of a direct investor, reduce some of those indirect costs. And so, I mean, obviously, having the right resource to be a partner with GPs is an important success factor in becoming a direct investor. But there is a talent pool out there, and the private equity class has matured. A lot of these things are not rocket science or hidden secrets anymore, and you can find that resource available if you're in the mindset of building that infrastructure.
So just to illustrate, how many people in the team today?
So we have 35 people across private markets.
Okay, thank you.
Yes, so we have about 35 people in private equity. I guess another 35 people in infrastructure, which would be comparable. But it's funny, because I come from operations and I was also a partner in a private equity firm, I think about resources maybe in a slightly different way than many institutional people. In fact, we have fewer senior people than when I joined, and we're twice as large in terms of our activities. So I hold that up to the board and say, you see, that's a private equity example. We came in and we re-engineered the firm, because I think size is important. And of course, when you're an institution, not only do you care about executing the deals, but you care about the governance afterwards. So part of your team, of course, grows just naturally as your portfolio grows. But I think it's very important that the process remain efficient, and that's probably one of the challenges in an institution. As you grow, ensuring that your process is still efficient. We're now, when I started, we were only in Montreal, Canada. Now we're in London, New York, and we're shortly be in Asia. So the integration, the ability for the teams to work in a tightly coherent manner becomes ever more challenging. And I'd say that's probably my number one focus. So yes, it's nice to have more resources, and probably the key is to get the right resources, as you mentioned. So we pay a lot of attention to getting the right resources, and secondly, our internal development of our resources. So.
Thank you. Thank you very much for that illustration. So as promised, a few words as well on economics, and then we'll open to the floor. So on the economic side, so right now, the cycle seems to be quite favorable to GPs, or at least to some GPs, who've got the upper hand to impose sometimes new terms or revised terms, lower hurdle, if any hurdle. So how do you think about it? Maybe we start with you, Kevin. How do you think about it when you engage in the negotiation with the GPs? Is it same as usual, just a cycle, or is it different approach?
No, we can actually use economics as a bit of a screening tool. Like I said, concentrated program, we're only doing about 2 new GPs a year. So we've got our certain minimums, don't mess around with the preferred, 100% offsets, 20% carry is standard, don't come to us with 25 or anything creative. We don't look at those A, Bs, and Cs. They're interesting to model, but we're pretty straight by the board terms-wise. So if someone comes with a 0 preferred or a 6 or 7 preferred, that actually is an easy screen out for us, because frankly, there's hundreds and hundreds of GPs out there. There's lots of very good ones. The difference between, is actually quite small over a long cycle. We're only picking 2, so it's actually to our advantage in a way if someone takes advantage of the GP's side of the pendulum right now, being on their side. We can just screen those ones out and move on. Okay. Maybe a little
so
harsh, but
compared to your neighbor, you don't suffer from need to invest in volume in a way.
No. We've with our size, we've got a wide opportunity set, so we can be choosy.
Terms are important, but it is, as we all know, a market out there. So, and LPs, if you get a room of only LPs, LPs will talk a fairly consistent game as to how they view the question of terms. But then once the pack breaks and the LPs go back to wherever they go, and they actually meet the GPs and have to make a decision on allocation, it is a market, and LPs fight over allocation, and therefore clearly the GPs have more of an upper hand today. I would say, though, that for us these are very much cultural questions. We watch what are the reasons that the GP might be pushing on terms. Is there really a logic to it, or is it really a question of self-interest and taking advantage of the market? And these are all things that will obviously enter into our consideration either now or in the future. I think we all expect that at some point the market might change, and institutions have long memories. So.
Thank you. And maybe, Geoffrey, to elaborate a bit on this one, but with a slightly different angle. So Kevin just alluded to, in a way, a reduced standard deviation between returns between various GPs. And you mentioned this morning the industry is, to some extent, getting a bit more commoditized. So how do you guys think about economics, but also how do you see that evolving over time, irrespective of the current top P market?
I think it's important to differentiate from kind of short-term trends where you have a lot of dry powder, a lot of distributions, a lot of LPs with a lot of capital to deploy, where right now it seems GPs have, or certain GPs have the upper hand. But the longer-term trends are, there's less differentiation between the lower quartile and the top quartile. There's less differentiation overall in the asset class. And so the long term means that that there will be, and overall higher valuations, lower returns, means there needs to be a focus on cost and cost of implementation. And so when you see GPs modifying their terms in their favor today, you have to wonder where they're going to be 5, 6, 7 years from now when they're looking back at the 2017 vintage, and what legacy have they created for themselves? by changing those terms, and which LPs have they lost, perhaps in that process. I think that's an important question. We don't have any red lines in terms of terms, but we do look at the relationship overall. Can we be a partner with this GP? What's the all-in blended cost of our relationship with them? And does it make sense overall? So we think very hard about economics. Is the summary to your question?
Thank you. Thank you very much. So opening to the floor now for questions. We'll have 6 minutes. Please. There's a mic coming for you.
You can see it. They're good for you.
Thank you. My name is Kamran Anwar. I work for a company called SS&C Technologies. So a question for the distinguished panel. So, within this LP-GP dynamic, to what extent has the whole narrative around operational efficiency of GPs, how has that evolved? And what are LP expectations around controls, operational efficiency, issues like governance? Your thoughts?
Who wants to take this one?
Sit here first.
You
I can
you
go
look like
first.
you have a good
All
answer.
right. Well, it's tougher for us. We're limited GP base. There's all sorts of models out there. We're believers that there should be some kind of operational expertise in the team, whether that's in-house or out-house. That gets into a whole cost and fee discussion, and that would be another panel. But we're definitely believers in there should be some. In this day and age, I think it definitely increases your value add. And we talked about the compression in returns. If you don't have that expertise, if there's a hiccup, I think the GPs we've had most success with have a team. Now, whether it's 40, 50 people, or again an outsourced team, there's all sorts of different models that are successful. And so I don't have a great answer other than say it's something we've been talking about. Is there a perfect model? I read a Bain consulting study where they've actually come up with 4 different terms for these different operating models, Maestro model and so on. They all work depending on the GP themselves, and we spend a lot of time, because we have, again, limited relationships, we have time to do heavy diligence. We spend a lot of time meeting these operating partners, figuring out how integrated they are and so on. And again, we get into the cost structure. That's important to us. Anyway, long, all over the map answer.
Any other view?
No? Good.
Controversial?
Good answer.
Yeah, I think there's a lot of focus from LPs on trying to understand how GPs are adding value. But if you get a GP, an experienced GP over many years, they often admit to you that their best deals are when management are in control and driving all the value added themselves and finding those management teams, and that's the way it should be. So the ability of a GP to control a company where they're sitting on the board has some limits to it, and I think that's a reality that as an LP you need to understand. However, as I say, as it's getting harder and harder to generate returns, the GPs that can take control of an asset and drive change with the management team in the most efficient way are obviously the ones who are going to do the best. But in the end, having the management team needs to be on board and driving that value added, that transformation. Otherwise, even with the best operations team in the world, it's not going to happen.
Yeah, I would just add to that quickly, because I come from an operating background, so I love the topic, and I think it is about creating value and having that kind of expertise. The trap I would watch, and sort of borrows on your last comment, is you really do need to have a strong management team in place. And the trap is for the GP to support a mediocre management team because they think they have the resources to go in and support that team for too long without making the necessary changes. If you ask most investors, who've had a number of years of experience, if we had Leon Black back up and asked him, if there's one area when he questions decisions that were made, it's usually that they didn't change people fast enough.
Any other question in the audience? Ah, sorry, I couldn't see you.
Hi, Enes Rumawi.
The mic is coming, just 1 sec. Thank you.
No worries. Good exercise. Hi, Enes Rumawi, the Catalyst MENA Clean Energy Fund. The question is that with such significant funds under management and a limited number of GPs that you'd support, how would you access more niche areas or opportunities?
I guess.
Yeah, it's a great question. It's a question that's constantly on our mind. So you mentioned, so you're in the renewable energy space, so that's a huge area of interest of ours. So we do have the scale challenge, and therefore the way we would think about that is, first of all, we actually use fund of funds. So we will use some specialized fund of funds to almost as I hate to call it the sort of feeder organization, because it is where we put a lot of our attention. We don't do this in an institutional way. One of the fund of funds we work with is almost dedicated to us. It's a fairly unique setup, as it's not a large institutional fund of funds. We meet with them every week. We go through the funds that are in their pipeline. In the case of renewable energy, we in fact, it's such a strong area of interest of ours that we actually have a captive management team that looks for opportunities. So we have several $1 billion already invested in renewable energy.
Great, smart.
Thank you.
Yeah, I mean, it's always been a challenge on scale to find niches. On the other hand, if the niche isn't big enough to drive the overall performance of the scheme, then we shouldn't be doing that. So it's finding niches that are big enough to address and move the needle for us is an important gating criteria.
So thank you. It's 4 zeros in front of me, so I promise to be spot on time. Thank you very much to the 3 panel members today. Thank you for the questions.